Welcome, everyone. My guest today is Mike Simonsen, the chief economist at Compass, to talk about his 2026 forecast and why it's pretty optimistic. Before we jump in, I want to thank our sponsor, Trust and Will, for making this episode possible. Mike, welcome back to the podcast.
Hi, Sarah. Great to be here.
Great to have you here. Of course, we have published your 2026, the Compass 2026 forecast, and then we've also published your analysis of that, which really focused on affordability. So I'm excited to kind of dive in and talk about that affordability part.
Yeah, the way we talk about 2026 is that it seems like it's starting a new era, the next phase for the housing market. So the last 4 years have been sales are really low, but prices pushing relentlessly higher, and therefore affordability getting worse. That's the last phase that we've been in. And in the next phase, inventory is sufficiently ample across the country now that two things can happen. One is sales can finally start climbing, and the other is that prices are flat at best, down in many markets, and incomes. So that means incomes are rising faster than home prices, and for the first time in a long time. And as a result, every day that happens, affordability improves a little bit. So we've had this relentlessly worsening affordability scenario, and now we're in finally an improving scenario where we're on the other side of that curve.
Where do you see, how do measuring affordability is interesting to me. So what's the baseline? Like, what's a traditional affordability metric that you look at?
So there's a few ways to analyze and categorize affordability. But one simple way is simply price to income, the price of the house to the income, the median price of homes to the median income of earners. And a traditional long-term number for affordability would be like a home prices, 3 times income. In the last decade, as home prices climbed faster than incomes, we had that rise into the 4 times income. And then during the pandemic, when prices spiked way up because people had very low mortgage rates, the price of the home was now well over 5 times income. And so by that price to income ratio, very unaffordable. And then we had the double whammy where rates climbed also, and so it was unaffordable by both those metrics. So now we have incomes rising faster than prices, so the price to income ratio starts to tick back down, and looks like it would get under 5 in 2026. So it's still not long-term affordable by the long-term scale, but better than 2022, for example. And then if we're lucky, we also get declining rates. And so you get a better price to income ratio and you get a better payment affordability. So all of those together work in a little more optimistic scenario than we've had in a few years.
I think the payment scenario is what most people think about, right? It's like,
yes.
Can you afford this a monthly payment? And when you look at that, not only is that the price of the house, the mortgage, but it is the insurance, it is the property taxes. And so I feel like there were like triple and quadruple whammies over the last couple of years.
There really have been. And the inflation-driven elements of unaffordability are not going away. So insurance went up because of claims, but also because the cost to replace things is more expensive now. And those aren't going, even if inflation flattens out, the costs don't go back down. So there are those sort of permanent increases in those costs. And that means it takes multiple years of incomes rising to get ahead of that, to get back ahead of that curve. So incomes have to rise faster than home prices, incomes rise faster than inflation in general, and catch up some of those over time. And I think we're probably in this next era in for a multiple year span where that is the case.
So let's talk about home prices. You mentioned inventory. Talk a little bit about what we've seen in the correlation there. When there's little inventory, you've got tons of people going for the same house. Prices rise. Their neighbors are like, "Oh, great! I could sell for that high price too." That holds true for a while there's low inventory, and then the inventory evens out. So maybe take us through the last couple years and compare that to where we are right now.
Yeah, there's a real easy correlation between unsold inventory on the market, and home price appreciation another year in the future. So you can sort of predict home prices in the future based on how much inventory has grown now. And so you can look and see in the over the last decade, inventory tends to decline each year, and home prices were rising pretty rapidly. Inventory declined really dramatically in 2020, and home prices rose really dramatically through 2021. Then in 22, inventory started rising, and by 23, prices had flattened out. So you have this 1 year lag on home prices versus inventory levels. So that leads to our forecast for home price appreciation in 2026. So this is in our big report. And we're looking at just a 0.5% price increase for the year nationally on average across the country. That means there's a lot of markets where home prices are negative. There's a lot of markets where home prices are negative already. And we talk about that in the report. There's 11 of the 20 big Case-Shiller cities are already negative, and almost all of those are trending lower each month. So the Case-Shiller is up 1.3% home price appreciation through September of this year, down from like 4% at the beginning of the year. So each month is declining. And of all the big cities, are the even the cities that have reasonably tight inventory, like Chicago or New York, where home prices are still up 4 or 5% from a year ago, those are on a downslope, and each month that appreciation rate declines a little bit. So we can see that inventory to price influence across the country, and we can see that there are plenty of opportunities for home prices to be negative, like finish negative for 2026, which would be a rare event, but is quite possible in the data now.
Do you feel like because we're constantly battling people being like, home prices are going to drop 30%, maybe in a market like Austin, right? That was
Mhm.
so overheated, you would see that. But, do you see any markets where you're like, oh, this is, like that kind of drop? Are you mainly seeing, your forecast would seem to say it's a pretty moderate decline, offset by other people, who are doing better, other markets.
Yeah, so there are some markets, and they're already known that the Western Florida markets and the Austin, Texas markets have been down pretty significantly from the peaks. Those are those are related to migration patterns. So we've been moving from the north to the south for many years. And in the last couple of years, as it got expensive, not just home prices, but insurance and all the things got expensive, we've stopped moving significantly. So for uh, at least a significant portion of this year, places like Tampa and Austin had actually outbound migration, like more people moving out than in. And as a result, those were the prices are adjusting most rapidly there. So in a city that has been used to long-term growth that saw negative migration, and Tampa saw it because of hurricanes, lots of things that kicked in there. So those things were uh, 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 cre- contributed to local markets that were some local markets that were down pretty notably. Other markets like the Midwest and Northeast markets still had reasonably tight inventory and home prices climbing. And then nationally, we have little bit positive, barely positive for the year as a national average. So they balance out. There is nothing in the data that says now that home prices broadly will crash in 2026. So big, like the big corrections. And the things I would be looking for there would be, so inventory is up now 13% year over year. Earlier in the year, it was up 30%. If inventory were still growing by 30%, or if the new listings each week were starting to explode, meaning sellers were seeing prices are lower and then they are panicking and then listing, those things would accelerate the bearish scenarios, and those are not in the data. And in fact, if anything, they're tightening again. So we can see, so that keeps a floor on pricing because those supply scenarios aren't there yet. And I watch for those every week because if those start to come, we want to know it.
Absolutely, yeah. I think it's interesting. So I was when everyone was moving in, especially from San Francisco, everyone when there was a lot of migration in from the West Coast into Austin. That summer, we had like 25 days in a row where it was over 105. And I felt so bad for those people. It was a pretty unusual summer. We don't usually have, like this last summer was pretty mild, a couple days, a week over 100, something like that. It was brutal. And I thought these poor people have thought, what have I done? And I'm sure that that didn't help the overall decision,
Yeah.
because weather is one of the reasons that people are in California and not in Texas. I mean, let's be honest.
Yeah, for sure. And so it's funny how weather has impact on those things. And one of the things we can see right now, for example, and we talk about this in the report, is the weekly pending home sales are climbing. Have been reliably a couple, 2, 3, 5, sometimes 8% above a year ago. So sales growing, that we're looking in the weekly pendings, and these are homes that will complete the transaction in the future. But they've been up for several months, and you talk about it on the podcast here. You talk about it with Logan. We see these each week. One place where we see that most commonly right now is Florida. So the Florida home sales are up pretty significantly over last year, over 2024, and that's partly because late 24 had three hurricanes that really slowed down sales. So even just having that weather related, Florida's a massive market, second biggest to Texas. And so having that much increase in Florida sales actually moves the needle for the whole country. So we can see that underway. And so in this next era, we talk about home affordability improving because incomes are moving faster than home prices. So home prices flat, barely positive, maybe even negative. But the other thing that's happening is that for the same reason, because there's more properties available, more sales can happen. So more sales are happening in Florida. They're up slightly in Texas. They're up in a lot of the country. There are a few markets like New York, which are still pretty inventory constrained, where sales haven't grown yet over last year. And so in 26, one of the things I'm looking for is, do we get a little bit more evening out of that inventory trends where it's been tight in the Midwest and Northeast? Do we get a little more growth there? I think inventory in New York is up like 10% now year over year. So that's improving, and a few more homes for sale allow a few more sales to happen.
Another really interesting thing in your analysis was where you looked at the mortgage rate that people have, and we're really starting to see that lock-in effect of people had 3% rates. How are they ever going to sell? Which, we have different opinions on that in this podcast sometimes, but you're really seeing that start to loosen. So maybe walk us through the statistics there of what it looks like, where people's rates are right now.
We've had that lock-in effect has really been fascinating. In 2022, 80% of the market has got under 4%. Some big chunk is under 3%. And as of now, at the end of 25, we've now had 3 full years of rising rates. In fact, 3.5 years of rising rates, almost 4 years of rising rates. And so there are now as many people with mortgages over 6 as under 3. So there are about 10 million people who now have, because over 4 years, these people have bought homes, and their rates are over 6. And so those folks will behave very differently from the folks who have rates under 3. If I get a new job offer with and I have an expensive mortgage, it's much easier for me to move, sell the house and buy a new one than it is if I've got the cheap mortgage and I'm stuck there. If I have an expensive mortgage and I lose my job, I am much more likely to go into a stress scenario, to need to resell that, to foreclosure. Those things are all much more possible, where for the folks with ultra cheap mortgages, much more unlikely. That means more liquidity, more uh, inventory. It means more opportunities for buyers. All of these things start to happen, and they slowly return to the market. The other way to look at that is the average rate that everybody has on their mortgage now is, I think it's 4.4% as an average, and that's the same average as 2019. So
Oh,
all of those, on average, we're back to where we were pre-pandemic, which I think is a fascinating set of dynamic. You have a K-shaped economy. We have the people with the really cheap rates and the people with the expensive rates. So it is we still have the the divergence to the benefit, but on average, we're back to where we were in 2019.
I also think that like rates stabilizing, say we, in the low sixes, it doesn't spur a refi boom, but it does spur maybe home building to I mean home buying, to your point.
Home
Like,
buying.
so you're not going to have, our originators are not going to be able to go out there and do a bunch of refis, but it does grease the market in the way of like more transactions happening, like
Yeah,
actually buying and selling.
I like to say that consumers are more sensitive to changes in rates than the absolute levels. So if rates settle in the low sixes, now I can make decisions about affordability, about my job, about those decisions about whether to to act. And if they've been in the low sixes and suddenly they spike to 7 again, that hits the brakes. Now I can't make that decision. On the other hand, if they're in the low sixes and then they hit 5.9, suddenly to a big chunk of people, that looks cheap.
Right.
And so that will spur a bunch of transactions. And so a couple of things I'm looking for in that 2026 forecast is, so we're expecting home sales to grow from about 4.1 million annual pace to 4.25 million. So it's a 4 or 5% gain next year. And that's because we can see weekly pendings are up that much now. We can see the slightly lower rates during the year. The beginning of last year, the first half of last year, rates bounced around 7, and that really kept sales very low. This year, if they bounce around 6.3, or if we get lucky in the first half of the year and they dip lower than that, that will keep that sales pace up. And then there's one of the things that I outline in the forecast, which is the Goldilocks scenario. How do we get to a lot of sales growth next year? And I wrote this up for HousingWire like a month ago. And in the Goldilocks scenario, we have a few things taking place. We get lucky with the timing of mortgage rates, maybe drop in the first half of the year to 6, or even 6.1, note a little bit, 20 basis points, 30 basis points cheaper than what they are now. We also can see things like there's been the withdrawal phenomenon in 25. More sellers are taking their home off the market when they don't see an offer that they like. You can either, don't get the offer, you can either cut the price or you can withdraw. And they've been withdrawing at a significantly faster pace this year than they have in recent years. And it can be very tempting to look at those withdrawals as a inventory supply, as a supply only. It's these people want to sell houses, and therefore in 26 they come back, and now there's extra supply coming. But when we look at that data, it looks to us like those are by and large owner occupiers who want to sell and buy. And so those are two transactions that want to happen. So if we get lucky with, for example, mortgage rate timing, those people, we estimate there's 150,000 people who want to do two transactions, who put it off from 25. They maybe put it off for several years, and in the right conditions, now they can come back and actually do two transactions. And so that would bring the sales pace up even more quickly in the first half of the year. So the golden that Goldilocks scenario would be those withdrawals come back and there are actually two transactions. It includes things like inventory climbing in New York, so New York sales can climb. It includes a few of those things hitting at the right time, and that would get us to maybe a 10% growth year if we're lucky next year.
Amazing. It's so nice to have a positive forecast. And, the different people I've talked to have different takes, but compared to 2 years ago, especially 3 years ago, oh my gosh, but even last year, I mean, we are going into a year where it feels like the industry can feel kind of sunny about this.
Yeah, at least some sales growth. And, a year ago when we did forecast, we were expecting some sales growth in 25. We ended up having mortgage rates higher for longer. And it really put the worst case scenario, having rates around 7 for the first half of the year. We didn't see demand pick up and sales start to climb until the second half of the year, when we're already on the seasonal downslope for the year. So it was really, we still got some sales growth. We got about from 4 million to 4.1 million, a couple percent sales growth in 25, but was still held back, and it could get held back again in 26 if the wrong things happen. If inflation breaks higher and keeps rates higher for longer, that would buyers have proven and sellers have proven perfectly happy to wait. And so if things break the wrong direction, then they'd be waiting again. Yeah. But we now have 4 years of waiting pent up, and you get the life events that really build up. Now we have 2 kids, and those things that each year gets a little more people that need to act, and each year we have a little more people with that expensive mortgage rate, so those people can act. And so we have each year a little bit of growth, and then with the right scenario, maybe we get some really noticeable growth.
Well, Mike, I'm fingers crossed for the more positive. And I just wanted to point out, you are going to be one of our featured speakers at the Housing Economics Summit on February 10th. And we couldn't be more excited. Great timing on that. I think, we picked that date for a reason. We should have some numbers in. We should know where we're going. Cannot wait to hear you speak there. And thank you so much for being on.
Sarah, it's a real pleasure. Always great to see you.